All right, let's jump right into this explainer. Today, we are unpacking a genuinely fascinating breakdown of what is shaping up to be a completely historic financial event. We're looking at a recent deep dive report from the financial channel Casual Finance about the upcoming SpaceX initial public offering. And let me tell you, the sheer scale of what's being proposed here is absolutely staggering. We're going to break down the numbers, the underlying business models, and some very quiet yet massive rule changes happening right now in the background of the stock market.
So the headline number floating around for this IPO is a target valuation of $1.75 trillion. Just let that sink in for a second. To put that completely astronomical figure into perspective, at that valuation, SpaceX would be worth more than every single American defense contractor combined. According to the source, it's actually worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all put together. It's a massive number.
Okay, let's dive into this, because here is where the financial reality heavily contrasts with that record-breaking valuation. While they're targeting a near $2 trillion price tag, the consolidated company actually lost $5 billion last year. Yep, you heard that right. We're looking at the largest valuation in history, sitting right alongside a massive $5 billion yearly financial loss.
Which brings us to the central financial mystery of our explainer today. It's the absolute first question you have to ask when you look at these numbers. Who on earth is stepping up to buy shares of a company that is bleeding $5 billion a year, especially at a $1.75 trillion premium?
Well, according to the analysis by Casual Finance, the surprising answer is you are, or more specifically, everyday passive retail investors and their retirement accounts. Within just a few weeks of the listing, your 401k is poised to become one of the absolute biggest guaranteed buyers of this stock. To understand how that's even possible without you actively choosing to hit the buy button, we really have to start peeling back the layers of this onion.
Section 1. 3 companies in a trench coat.
And this brilliantly illustrates exactly what we mean. To make sense of the financials, the source points out that you really can't look at SpaceX as just a rocket company anymore. I mean, if you ask someone on the street, they'll say, oh, they build rockets, they're going to Mars. But the reality? The modern iteration of SpaceX is basically a mashup of 3 completely distinct businesses stacked on top of each other. Looking at the revenue, Starlink actually makes up the lion's share at 61%. The traditional rocket business brings in about 25%, and the remaining 14% comes from other ventures. So the rockets aren't even the primary revenue driver anymore.
But before we talk about those profitable parts, we need to address the newest addition, which, the source neutrally reports, is actively draining the company's cash. Recently, SpaceX acquired Elon Musk's artificial intelligence lab, XAI, in a massive all-stock deal. Casual Finance actually describes XAI as a reverse Jerome Powell. Instead of printing money, it is currently burning through whatever cash the rest of the business generates, to the tune of over $1 billion every single month. And this is all happening despite the fact that by March of this year, all 11 of the original heavyweight co-founders from places like DeepMind and Google had actually walked out, leaving the company to be essentially rebuilt from scratch.
Because of this, the source argues that XAI is vastly overvalued, especially when you place it side by side with its direct market competitors. Look at OpenAI, generating roughly $24 billion in revenue and valued around $850 billion. Or Anthropic, making over $30 billion with a $400 billion valuation. But XAI, they estimate just $1 billion in revenue, yet it was valued at $250 billion in the SpaceX acquisition. The market is pricing it at a massive premium, despite it having just a fraction of the revenue of its peers.
Then you have the traditional rocket business. This is the part of the company launching satellites, running cargo to the ISS, doing crewed missions for NASA. Last year, that segment generated about $4 billion in revenue. Now, hey, $4 billion is a very impressive number on its own, for sure. But in the grand scheme of a $1.75 trillion valuation, it is just a tiny drop in the bucket.
Section 2. The Starlink engine.
This brings us to the segment that investors actually care about the most. The division that's effectively paying the bills for everything else we just talked about. This is the true financial crown jewel of the entire operation. Starlink. It's a satellite internet provider, and its sheer scale is historic. Since launching its beta in 2020, it's become the fastest scaling telecom company in history. We're talking over 10,000 satellites in orbit, beaming internet to more than 10 million active subscribers across 150 countries. For 2025 alone, Starlink is projecting an incredible $11.4 billion in revenue. And it's not just consumer internet. They're embedded in maritime shipping, commercial airlines, and heavy-duty classified defense contracts.
But honestly, the revenue isn't even the most impressive part here. It's the accelerating efficiency underneath it all.
Just 2 years ago, Starlink's profit margins were sitting at 41%. Fast forward to this year, they've expanded massively to 63%. This telecom division is incredibly efficient, and they're basically printing cash at an expanding rate. So the crucial point is, we have a paradox. By themselves, Starlink and the rocket business are incredibly successful, bringing in roughly $8 billion in profit. But when you consolidate the whole company and toss in that massive billion-a-month cash burn from XAI, that $8 billion profit is entirely wiped out, and you're left with a net $5 billion loss for the overall entity.
Section 3. Rewriting the NASDAQ rules. So the obvious question, if the consolidated company is losing $5 billion, how exactly is it going public at record-breaking numbers? Well, the answer lies deep in the systemic plumbing of the stock market. According to the source, the rules have quietly been changed right before the biggest IPO in market history. Back on May 1st, NASDAQ adopted these new fast entry rules. The old rules were pretty strict. They were designed to protect the market by allowing time for price discovery. A newly listed company had to wait 3 whole months before being added to the prestigious NASDAQ 100 index, and it had to have a minimum of 10% of its shares available for the public to trade, which is known as the float. But the new rules? They slash that wait time down to just 15 days and completely eliminate the minimum float requirement.
Let's move to and see how this builds step by step. First, that fast entry rule means 3 months of vital price discovery is compressed into just 3 weeks. Second, getting rid of the minimum float means SpaceX can qualify for the index while reportedly targeting a tiny free float of just 4 to 5%. And third, there's a brand new, highly technical rule change that effectively acts as a hidden multiplier.
Here is how Casual Finance explains that hidden multiplier, and it's wild. For companies with a free float under 20%, NASDAQ now legally treats that float as if it were 3 times bigger than it actually is. So SpaceX's tiny 4% public float gets weighted by index funds and ETFs as if it were a 12% float. The market plumbing is effectively manufacturing artificial demand. It requires funds to buy way more of the stock than is actually representative of its public availability.
Which brings us to Section 4, the ultimate exit liquidity. What does all this manufactured artificial demand mean directly for you, the everyday retail investor, and your 401k? Well, this is where the red carpet that NASDAQ rolled out ultimately leads. In a typical IPO, a company might allocate, 5 to 10% of its shares to retail investors. But SpaceX is reportedly targeting a massive 30% retail stock allocation. That is a highly unusual, massive amount of supply being directed straight at everyday buyers for an initial public offering.
The company's CFO, Brett Johnson, recently explained this strategy to bankers. He said, "Retail buyers have been incredibly supportive of us and of Elon for a long time, and we want to make sure that we recognize that." The source neutrally interprets this corporate messaging as a pretty calculated strategy, using a highly loyal retail base to absorb a massive 30% of the supply being dumped onto the market.
But it goes far beyond just the retail buyers who are logging into their brokerage and actively choosing to hit the buy button. The NASDAQ 100 is tracked by over 200 investment products holding over $600 billion in assets. Once a company is squeezed into this index, which, remember, those new fast entry rules guarantee will happen in just 15 days, the mechanics of passive investing force all of these funds to automatically buy the stock, sight unseen, just to match the index.
Now, what's really interesting about this slide is how it all ties together. As portfolio manager George Noble bluntly puts it, your 401k is the exit liquidity. The buyers and sellers don't show up to the party at the same time. Early insiders and private investors who are sitting on low-cost shares are unlocked later to sell. The buyers, your passive index funds and your 401k, are forced in early, at peak valuation, to absorb those shares.
So, look, passive investing has always been sold to us as the smart, low-fee, set-it-and-forget-it way to build a retirement. And it is, but it clearly comes with a hidden catch. The exact same mechanism that automatically buys the entire market for you also guarantees that you will blindly buy whatever heavily indebted company manages to get the rules rewritten to squeeze into the index. It leaves us with a really critical question to consider. Is the incredible convenience of passive investing actually worth completely losing your choice in what your hard-earned money automatically buys? Thanks for joining me on this explainer, and definitely keep asking the right questions about where your money is going.